Welcome to another PCS Legal video. Today we're going to discuss shared ownership property. We have of course produced a previous video that briefly explained shared ownership properties, but this video today will just expand on some of the points that we've made previously. So shared ownership provides an affordable way to buy a home. You purchase a share in a brand new home and pay a subsidised rent on the part that you don't own. In the future, if you wish, you can usually buy further shares until you own your home outright. So reasons for purchasing a shared ownership home. Well, you own part of your home rather than paying rent with no return. You will only need to secure a mortgage for a percentage of the property price rather than the whole amount, making it more affordable in the short term. You will also need a much smaller deposit than you would if you are buying a property outright. In addition to this, the combined monthly mortgage and rent payments of shared ownership usually work out cheaper than buying outright. They are also often less than renting a similar property privately. In most cases, you can buy additional shares of your home if you wanted to. As your income increases, you can buy more of your home, which means one day you could own your home outright. The more of the home you own, the less rent, of course, you pay. You only buy the share you can afford, so you don't have to overstretch yourself financially. In addition, there are a variety of homes that may be available, from one-bedroom apartments right through to large family houses. So how? Shared ownership enables you to buy a share in a new home and pay a subsidised rent on the remaining share. The initial share you buy will usually be between 25 and 75% of the full purchase price, and is tailored to suit your circumstances, meaning it is not only affordable to you now but also in the future also. You will pay a subsidised rent on the share that you don't own, and in most cases you have the opportunity to purchase further shares in your home if you wish to. This is known as staircasing. When you purchase further shares in your home, the rent reduces accordingly. If you staircase to 100% ownership, then there will be no rent to pay. So what are you purchasing? When you buy a home with shared ownership, you are the home owner and will take on all the responsibilities and gain all of the benefits that go with owning your home. You begin by purchasing part of your home under a lease. A lease is a legal document between you and the housing association which proves that you own part of your home and will set out certain conditions which, for example, include your rights and responsibilities as a homeowner, how often your rent and service charge are reviewed, and what you should expect from the housing association. Since you purchase your home under a lease, you will be a leaseholder and the housing association will be what is known as your landlord. You will have all of the rights and responsibilities that you would have if you owned your home outright. So we often get asked, what happens when you come to sell? Well, just like any other homeowner, you are free to sell the percentage that you own to any other eligible person at any time. It is normal for the lease to contain a provision that you offer the housing association the right of first refusal. On the basis they do not wish to purchase the property from you and you decide to sell your share, you will instruct an independent valuer to set the selling price for you. The housing association will also help by searching for a possible buyer on their waiting list, as this will also help you reduce the cost of selling your share of the property. Housing associations will normally have a waiting list of people looking to buy properties of this nature. You will of course need to obtain consent for the sale from the housing association, and any potential purchaser will need to be approved by the association. You may need to pay fees to the housing association, and it is important to check the terms of your lease before you engage in your sale. The lease term. Well, shared ownership leases are normally granted for a term of 99 years, and there is no statutory requirement under the terms of the Leasehold Reform Housing and Urban Development Act 1993 for these to be extended. This is due to the tenants having a right to purchase further shares in the property and generally being able to own 100% share of the property, at which time the lease extension could be requested if required. Staircasing. So buying additional shares in your home is known as staircasing. The price you pay for additional shares is based on the market value of your home at the time you're looking to buy. The value may go up or down according to the housing market conditions generally. The value of your home will be set by an independent RICS surveyor. There will be some costs involved in staircasing, such as the valuation fee and of course lawyer fees, although it shouldn't cost as much as buying the initial shares in the first place. The more shares you buy, the less rent you will pay on the remaining part of the property. If you staircase and own the property outright, you can sell your home on the open market without consultation with the housing association or any restrictions that may apply when it comes to selling, detailed in your lease. In most cases, you are able to staircase up to 100% ownership. At the time, you will then become the freeholder of your own home. Stamp duty. Another potential subject to consider when buying this type of property is the stamp duty you pay, or SDLT for short. This is a tax payable on all property transactions. Calculating SDLT on a purchase transaction is normally straightforward, but the rules associated with SDLT on shared ownership properties are rather more complicated. If you are being granted a new shared ownership lease, for example the purchase of a new build property, then you have an option of either paying stamp duty on the full market value of the property or paying duty on the price being paid for the initial share and on the specified rent payable per annum. Stamp duty may also be payable when staircasing and purchasing further shares in the property. This will depend on the original owner and what duty they paid on the full value of the property, or whether it was just a proportion they purchased. Stamp duty may also be payable when staircasing and purchasing further shares in the property. This will depend on the original owner or what fees were paid and what duty was paid on the full value of the property, or whether it was just a proportion that was purchased at the initial acquisition stage. The method to work out how much tax is payable depends on a number of factors, which we can advise you on as and when you instruct us. If you have any further questions regarding shared ownership properties, please don't hesitate to contact any one of our managers across any one of our offices in Basildon, Ongar, Wickford or London.